welcome back to The Explainer. Today, we're unpacking a fascinating reality of our modern world. Just how deeply interconnected the global economy really is. I mean, you've probably noticed it, right? How a diplomatic dispute thousands of miles away can suddenly make your morning coffee or your commute to work a whole lot more expensive? Well, it's not just a coincidence. It's a measurable, really powerful ripple effect. And today, we're going to look at exactly how it works. Which leads us to our core mystery for today. How exactly do high-level negotiations in the Middle East end up weakening a currency way down at the southern tip of Africa? We're going to literally connect the dots between local currency drops, specifically the South African rand, and this complex web of global geopolitics. All right, let's dive into this. Here is our roadmap for today. 1. The rand's recent slip. 2. Understanding foreign reserves. 3. The U.S. Iran factor. 4. Oil prices and inflation. 5. The central bank's tightrope. And 6. What signals to watch. Starting with Part 1, the rand's recent slip and assessing May's economic data. So, the South African rand weakened after May data showed a decline in the country's gross reserves. Now, financial markets, as you know, do not operate in a vacuum. This specific data point dropped right into a pot that was already boiling with heightened volatility linked to stubborn global inflation and broader geopolitical uncertainty. So it wasn't an isolated incident. It was more like a domestic spark hitting a mountain of dry global tinder, amplifying a reaction that might have been much smaller in a calmer global environment. A really fascinating insight from our source material highlights this extreme sensitivity. It notes that the rand is one of the most actively traded emerging market currencies and often reacts quickly to both domestic and international developments. Because it is so highly liquid, with trading volumes that far exceed what you might expect for an economy of its size, investors use the rand almost like a global macroeconomic thermometer. This extreme liquidity means it reacts instantly and sharply to breaking news across the globe, absorbing the shocks of international sentiment shifts in real time. Moving to Part 2, Understanding Foreign Reserves, or de-jargonizing the finance. Let's do a quick refresher on the underlying mechanics at play here. Foreign exchange reserves are basically a measure of a country's ability to withstand external economic shocks and support broad financial stability. Think of them essentially as a national shock absorber. When a country hits an unexpected economic pothole, these reserves are what help smooth out the ride for the domestic currency. So when that May data showed a drop in these reserves, the market essentially saw South Africa's macroeconomic suspension getting a little bit thinner, just ahead of what looked to be a very bumpy global road. But we really need to keep this specific data drop in perspective. While this decline directly translates to weaker sentiment, heightened caution from traders, and a hyper-awareness of elevated global risks, it crucially does not represent an immediate threat to South Africa's overarching financial position. Okay? It wasn't a blaring crisis alarm warning of an impending default. Rather, it was a flashing caution light, blinking precisely at a time when global capital was already feeling remarkably jittery and looking for any excuse to pull back from emerging markets. Which brings us to Part 3, the U.S. Iran factor, the global geopolitical variable. Now zoom out with me for a second. Global investors are closely monitoring U.S. Iran talks for their potential impact on energy markets. This is the massive macro driver happening in the background. High-level diplomatic negotiations between these nations wield an outsized, sweeping influence on global market sentiment. What happens in these negotiation rooms literally dictates risk appetite and, by extension, exactly how trillions of dollars in capital flow around the entire world on any given day. And financial markets, while they interpret the potential outcomes of these high-stakes talks through a highly binary lens. Any escalation in tensions places immediate, renewed upward pressure on global energy costs. The logic is straightforward. Geopolitical friction threatens supply chains, making oil instantly more expensive. Conversely, any progress towards stability eases those deeply entrenched inflation concerns. Traders watch these diplomatic rooms impartially, focusing purely on the mechanics of how the final outcome dictates the price per barrel of oil, which then cascades into nearly every other asset class. Part 4, Oil prices and inflation, mapping the domino effect. Let's look at exactly how that global tension physically hits the local economy. Step 1, an escalation in the Middle East instantly spikes global fuel costs. Step 2, that expensive oil physically arrives in South Africa, leading to an immediate, unavoidable surge in domestic transport expenses. Step 3, because everything from your basic groceries to heavy industrial materials moves on diesel-powered trucks, those transport expenses rapidly cascade into rising consumer inflation. And Step 4, Ultimately, this widespread inflation squeezes corporate margins, resulting in significantly higher business operating costs across the board. The domino effect is incredibly fast, turning a diplomatic standstill abroad into an immediate cost of living increase at home. On to part 5, the central bank's tightrope, balancing domestic and global risks. South Africa and its investors are currently facing a highly delicate balancing act. Policymakers have to navigate stubborn, sticky inflation risks at home, simultaneously manage the much higher interest rates designed to combat that inflation, and execute all of this while facing a notoriously challenging and unforgiving global economic environment. It's literally a monetary tightrope. Reacting too aggressively to one pressure point, say hiking rates too high to kill inflation, might unintentionally stifle economic growth and expose another vulnerability entirely. To manage this complex environment, the South African Reserve Bank tightened monetary policy to control inflation amidst these consistently elevated external risks. By raising rates, the central bank is taking direct, forceful action to demonstrate an absolute determination to keep inflation anchored. And they're doing this even when the root cause, those global oil prices and geopolitical tensions we just mapped out, remains entirely outside of their jurisdiction. They're essentially building up the domestic economic walls as high as they can to keep the worst of the global storm out. Finally, part 6. What signals to watch to navigate future volatility? So, what does this all mean? If you want to know where the rand is heading next, you have to continually monitor 3 interconnected variables. First, global risk appetite. This sentiment dictates capital flows into emerging markets. If the global environment feels safe and predictable, capital flows freely and the currency benefits. Second, global energy prices. As we've seen, the price of oil feeds directly into local transport costs and consumer inflation, acting like a tax on the domestic economy. And third, confidence and fundamentals. This is what drives the daily, massive decisions of equity and bond investors who need to trust the country's underlying economic health before committing their capital. For the rand to truly regain its firm footing and break out of this volatile cycle, we need a specific alignment of overarching global conditions. We're looking for an easing of major geopolitical tensions, a sustained moderation of inflation pressures worldwide, and a true stabilization of energy markets. It requires a lot of massive, moving global puzzle pieces to fall perfectly into place for sustained local relief to finally arrive. Which leaves us with a vital question to ponder. With sustained uncertainty around international capital flows, how long will global energy markets keep currency volatility elevated? It's a stark reminder that as long as the global political landscape remains in flux, local currencies will continue to feel the waves. The butterfly effect in global economics is very, very real. A signature on a treaty in one hemisphere can literally alter the price of goods in another within hours. Thank you so much for joining me on this explainer, and definitely keep your eyes on those global signals.